Hey everyone, happy March. This is Charlie and David, certified financial planners with Platinum Point Financial. And it's everyone's favorite time of the year, March Madness. But along with that comes tax madness, right? So we wanted to create a video here today, share with you 5 strategies that can help with taxes for this year as well as future years. Starting with a common one, retirement plans, right? So walk us through, Dave, the tax savings available there.
Yeah, thanks, Charlie. So when you think about your retirement plans, your employer plans at work, there's two things we really focus on. One is your contributions. Every year, the IRS will adjust how much you can actually put into your 401k. This year, it's 23,500 if you're under the age of 50. And if there's catch-ups for both anyone over 50 and from ages from 60 to 63, there's an additional catch-up this year as well. That's very important to think about is how much you're putting in. You may need to adjust that on your pay stubs every single year. But in addition to that, it's also important to think about where's the money going. There's two options typically in most plans. There's the traditional and the Roth side. If you put money into the traditional portion, you get the tax deduction today. So if you're under the age of 50, 23,500 can go in the pre-tax. That reduces your income by that amount, thus your taxes. However, as that money grows and continues to grow down the line, when you pull it out, every dollar that will be taxed to you. So that might not always be the best solution. You also put money into the Roth portion, which is not a tax deduction today, but it grows tax-free for you in the future. Typically, we recommend a mix of the two. It really depends on your financial situation, your financial goals, and when you want to plan on retiring.
Excellent. Yeah, and I think a lot of folks are aware of that maximum deferral limit, which for 2025, as you mentioned, is 23,500. But some folks I don't think know that you can actually, from time to time, put additional dollars into those retirement accounts. Share with us what that looks like.
Absolutely. So it's always important to review your employee benefits every year because some employee benefits provide something called an after-tax account inside of your 401k. And the after-tax account should not be confused with the Roth 401k. As you mentioned before, you can put 23,500 into either the traditional or the Roth or a combination of the two. You actually have the capacity to put in $70,000 a year between your employer and employee contributions into your retirement plans. So the way you get around that is you add more money to this after-tax account. We call it a mega backdoor Roth because in addition to adding additional money to this account, call it $20,000 you're putting in there every year above and beyond your 23,500. If you immediately convert that to the Roth, then it will grow tax-free for you and all the earnings will be tax-free as well. So it's a huge tax benefit that a lot of people don't take advantage of because they're just not aware it's available within their plans.
Yeah, absolutely. What about before we move on from employee benefits? So benefits through work. Anything else from a tax standpoint that people should be aware of?
Absolutely. And I think we'd be remiss to say, I mean, we're talking about tax strategies here. One of the best accounts you can ever have for tax strategies is the health savings account. It's the only account that's out there that provides a triple tax advantage. So the contributions you make to the account, you get a tax deduction for it in today's dollars. As the money grows inside the account, it also has a tax-free growth. You can invest that money so you can see substantial growth in there. And then when you draw the money out to pay for healthcare expenses, that money comes out tax-free as well. Now, you do have to have a high deductible savings account, high deductible healthcare plan to take advantage of the savings accounts, but it's probably worth it in most cases.
Excellent. Yeah, like you said, one of our favorite accounts, and I think that can make a lot of sense depending on your situation. What about beyond the employee benefit side of things? What else can we think about in terms of tax savings?
Absolutely. When we review our tax returns, a lot of our clients, we notice they're giving monies to charities, but they can't itemize that and give the deduction because the standard deduction now is so high. So one advantage that we've started sharing with clients is to stack your tax deductions for charitable contributions in one year. And the best way to do so is through a donor advised fund. So essentially put in $10,000, $15,000 a year to this donor advised fund. That with your other deductions will help you exceed the SARA deduction so you can itemize your taxes, take advantage of the charitable gifts you're already giving and reduce your taxes. One more great point with the donor advised fund is you can either put cash in or a stock. So if you have highly appreciated stock, you can always contribute that directly to the fund. And you don't have to realizing any capital gains on that, and your money goes to the charities that you care about.
Excellent. Yeah, I know it sounds like a win-win, really. Donating to a cause you care about, but also being provided that tax break as well. So when we think about the markets year to date, right? A lot of volatility, a lot of uncertainty out there. What from the tax standpoint is available within folks' investment accounts?
Yeah, anytime you have money in a taxable account, you want to be aware of what the market's doing and what your gains, unrealized gains on that account are. What we do for a lot of clients is we realize some of those losses. We do something called tax loss harvesting. So we'll realize a loss for a client, reinvest those funds in a similar fund that's going to still capture the gains when the market goes back up again. But you now have this loss you can carry with you throughout the rest of the year. If you don't have anything to offset it with at the end of the year, you can deduct $3,000 on your income for 2025. If you do have other capital gains, you realize that loss and the gain can be offset to one another.
Excellent. Yeah, that makes a lot of sense. It sounds like that's probably an approach you want to be a little more hands-on with, as opposed to just doing this, at the very end of the year. Um, Appreciate you sharing that with us, Dave, and wanted to keep this short and sweet here today. One or more of these strategies may be appropriate for your situation, but it's always critical to make sure you're discussing this with a professional before making any of these moves. So we'll wrap that up here today. If there's any information, if we can help out further, feel free to reach out. You can reach us on our website, which is platinumpointfin, that's platinumpointfin.com. And good luck with those filling out those brackets this year. We will see you guys in the next video.